I'm Brian Johnson, founder and managing partner of Johnson and Company. I publish these marketing and fundraising intelligence briefings to help new first-time sub 100 million AUM alternative investment managers and their advisors make better and more informed decisions about the marketing and fundraising process. Obviously, we all understand that raising assets is the number one objective for a sub-institutional alternative manager. And unfortunately, there's a great deal of hype, noise, myths, and fiction about raising assets for new, first time, and smaller managers. And hopefully, this brief presentation will help to address some of those issues. In regard to Johnson and Company, I've been in the business about almost 30 years now as an investor, marketer, salesperson. I had a fund of my own. So if you're a small manager out there, I sat where many of you have sat right now with a small fund and wanted to raise significant assets. I was fortunate to do so. But I want to say here from the outset, this presentation is not designed to be any propaganda about Johnson and Company or promotional about Johnson and Company or myself. It's designed to be informational and instructional for managers so they can, again, make better, more informed and intelligent decisions and achieve success in what is their most important objective, and that is raising assets. So, as I said from the outset, there's far too much noise, completely wrong information about what it takes for new and smaller managers to raise assets. At Johnson and Company, when I started the firm back in 2010, I wanted everything that we did to be data driven. So we are operating and executing from facts and not from fiction and not from feelings. That way, we can make some, again, informed and intelligent decisions. So, what I'm going to be displaying here for the next few moments as we go through this is the facts of fundraising and marketing. And so, managers can really understand what it takes and they can make the commitment and have the conviction to do what it takes to be successful. And again, in their most important objective, and that's raising assets. So, we're going to be dealing in a fact based world here, not feelings. And hopefully, that will be helpful to some of you out there. So, first of all, success needs a process. Any of you who are doing extremely well in your investment side of the business, you are executing from a process, a structured, disciplined, and focused process that you execute consistently at a high level. That's why you're generating alpha. The same has to be true for your marketing process. The marketing process also has to be done from a structured, disciplined, focused way, and it has to be consistently executed at a high level. Without process, whether it's on the investment side or whether it's on the marketing side or whether it's in fundraising, without process, typically there is inappropriate, inconsistent, and improvisational activity. And that leads to suboptimal outcomes. So the first thing we want to do is understand that marketing is a process and that it takes a structured, disciplined, focused approach and to be consistently executed at a high level. And it's important that managers understand the distinction between marketing and capital raising. Again, they are distinctly separate processes, but they are critically complementary to each other. Unfortunately, a great many people conflate the two, and they think the marketing and capital raising are synonymous. They are not synonymous. They do go hand in hand, but again, they are distinctly separate processes, but they're critically complementary to each other. In the marketing process and raising and capital raising all emanate from three things: people, relationships, and trust. Despite the use of quantitative metrics that we're all accustomed to, at the end of the day, this business is about people, relationships, and trust. So it may seem transactional on the surface, but the real drivers are those three things: people, relationships, and trust. We're going to get into the heart of that as I go through this briefing. The objective of the marketing process, again, consistent high level execution is mandatory. But again, it's about people. So you want to continually identify the most suitable and appropriate investors given the manager and the fund profile. You want to build relationships of trust and actionable conviction with those people, not by pitching, because pitching is not marketing. And I'll say more about that. But you want to build relationships of trust and actual conviction with people by engaging in an investor centric, prospect specific manner in order to gain their trust. That means consistently fill and maintain a pipeline that's sufficient to raise, retain, stabilize, and expand your assets under management from an economical, efficient, and expedient capital raising process. So again, if you want a pipeline that's functional, that produces for you, again, with the right people, the right relationships, and the right level of trust, in your pipeline, then again, that's all emanates from the marketing process. Again, marketing enables you to have an efficient, economical, and expedient capital raising process. Again, they are distinctly separate processes. Do not conflate the two. So if you're a hedge fund, the typical first stop that you make in the capital raising, you know, process outside of your friends and family is typically your prime broker and the capital introduction team. And again, as I said from the outset, we want everything that we do to be data driven. So we have to understand what the real world is of marketing, what your real options are. And this is a data point from AIMA, the Alternative Investment Management Association. It says that 4% of managers with less than 100 million AUM secured an allocation via the cap intro relationship. Now, cap intro at prime brokers, they're great people, intelligent people, hardworking people. However, they're not magicians. They can only help you as a small manager when you get to close to the minimum institutional threshold, which is about 100 to 150 million AUM. That's when the cap intro team at your prime broker can shine and do what they do best. The expectation that prime broker cap intro can help you if you've got 5, 10, 15 million is a false expectation. So again, in order to have clear eyes and a right focus, understand what your real options are marketing and raising assets. So insofar as the cap intro team is concerned, from the data point here, only 4% of managers with less than 100 million secured an allocation via cap intro. The next stop, that people typically make is looking for commission-only, performance or success fee-based third-party marketers. And this statistic is even more sobering than the previous one. According to AIMA, 0% of managers with less than 100 million AUM secured an allocation via third-party marketer. So again, if you combine the 4% from cap intro and the 0% here, at the end of the day, it's a DIY, do it yourself, you're on your own process of marketing and capital raising for small sub-institutional managers. The information on the screen here from an economic standpoint kind of lays out the compensation situation for a third-party marketer who wants to work with a smaller firm. If a firm has a 2 and 20 compensation structure, and the marketer has a traditional 3PM compensation agreement, which is 20% of the management fee and 20% of the performance fee, and that 3PM raises 50 million from the ideal investor segment for a small manager, which is private wealth. That means the management fee would be $1 million, which is 2% of 50 million. And then the third party marketer will receive 200,000 of that. However, we all know there's no free lunch. So there's expense involved in marketing and also raising assets. And that expense, generally in private wealth, the research shows is about 4,000 per million, about 40 basis points per million. So if they raise 50 million, the expense is 200,000. So net on the management fee is zero compensation to the third party marketer. So that means the manager, the 3PM's compensation is entirely derived from the manager performance. And if the manager has a poor year, then the marketer makes no money. So it's a very risky proposition for the marketer. And until a manager gets to, again, that minimum institutional level threshold, I would say between 150 to 200 million, resources like dedicated third party marketing are really not a viable option for the manager. Most managers that I've spoken to over the last 13 years or so firmly believe that performance is going to bring all the assets that they need. That all they need to do is put up numbers, and the world's going to be the path to their door. And what you'll see throughout this presentation is that's categorically not true. Here's a statement from probably one of the titans in hedge fund marketing, Don Steigenberger and Agecroft Partners. And he says it quite clearly that an effective sales and marketing strategy is critical. High quality marketing is critical. Performance is of secondary importance to perceived safety and reduction of headline risk, particularly for smaller managers. And if we could overlay that comment with some data, 27% of sub 100 million AUM managers do not invest in marketing, according to AIMA. 81% of those managers do not have a formal marketing process. Almost 77% of hedge funds tap out their entire network within 1 year. And 89% never reach or never get close to 100 million AUM, which is the credibility threshold. And all that emanates from lack of a marketing process. So the marketing process is existential to raising assets. Again, if you do not have a marketing process, you cannot have an effective, efficient, and expedient capital raising process, because the marketing process is where you form the relationships in order to make that capital raising process as efficient and expedient and as economical as possible. So again, when I started Johnson Company back in 2010, I wanted everything to be data driven. I didn't want it to be based on feelings. I wanted it to be based on facts. So one of the things that we do quite frequently is do surveys and keep our finger on the pulse of what people who are in the decision making process, but what are they thinking? What are they saying? So here's some comments from a survey that we did not long ago. And it's basically they're all saying the same thing. That a manager's long-term track record, it's not the main driver. In other words, we want to buy a process. And I think finally, the last comment is that people want to understand the process behind the performance. Everything, including organizational structure, reporting process, technology, service provider relationships, they are all factors in the capital raising effort. So if you're a small manager and you think that all you need to do is put up, performance numbers, think again. There are qualitative and quantitative metrics and criteria that professionals use in evaluating managers. And when I talk about evaluating managers in the environment that we are in now, in the environment that we've been in probably for the last, probably 10, 12 years at least, investors, intermediaries, advisors, they're idiosyncratically demanding. They're hyper skeptical. I mean, in the hedge fund space, there was a long period of underperformance that brought out that hyper skepticism, and they're stringently demanding. So they're stringent about the managers that they're going to select. The due diligence process, that I will talk about here shortly, has expanded. It's expanded strategically, tactically, and that leads to temporal expansion. And I'll speak more to detail about that. But again, if you think that again, all it takes is investment performance, and all you do is pitch performance, you will not bring in assets. What you need is a process, a marketing process, a structured, disciplined, and focused marketing process that executed consistently at a high level. Just like the investment alpha that you generate, the marketing alpha has to be on the same level. A few more data points here. Again, we want to be based in fact as we make our marketing and fundraising decisions. A study by Goldman Sachs, prime broker, of their clients since 2009, almost half are out of business, with the majority closed within 3 years. Recently, Preqin came out. For the first time ever, there are over 30,000 active hedge funds globally. 60% of those here in the U.S., so that's about a little over 18,000. For those of you who are listening and thinking about starting a PE fund, or you already have a PE fund, there are over 4,000 funds in the market currently seeking to raise a little over $1 trillion. And then finally, what are the investors looking for from a size perspective, qualitatively? 38% seeking funds over $1 billion, 36% and I would call this the new sweet spot from 100 million to 500 million. Only 15% of investors are looking at funds with less than 100 million under management. And as an aside, some data not long ago, 96 cents of every dollar in the hedge fund space goes to those managers that have 5 billion and up. So if you're a sub-institutional manager, new, first time, less than 100 million, it's a hyper competitive capital raising environment, and you've got to be really prepared, ready, polished, because you're going up against some of the best people in the business, some of the most intelligent people in the business, and effectively you're all competing for the same dollar. So if you are not prepared, completely adequately prepared to execute at a high level in a hyper-competitive environment, you will not succeed raising assets. Talking about what investors are looking for and what they're doing, we're coming out, again, that hyper-skepticism that I mentioned just a moment or two ago. So the devil that you know is better than the devil that you don't know. And here's a quote from a recent survey conducted by SS&C that basically says that, When forced to choose between allocating to new or emerging talent or re-upping with managers with proven track record, i.e., managers that they already have a relationship with, the investors are sticking with those managers that they know. So to have an investor, intermediary, an allocator allocate to a brand new manager takes a tremendous amount of conviction from that particular source. And achieving that level of conviction is entirely dependent on the manager and their execution of the marketing process. And understanding the marketing process from the investor, intermediary, allocator standpoint, understanding what what are they looking at? What are they looking for? What problems do they have? What's the solution that they're seeking? Because they're very clear-eyed about what they're looking for. So if you know what they're looking for, then you should know how to present yourself in the way that it makes it very clear and easy for them to assimilate what you do to say, this is the solution that I've been looking for. But again, the devil that they know is better than the devil that they don't know. So it's going to take even a greater marketing effort for a new emerging manager with whom they don't have a relationship to gather that allocation. One of the questions that I get in working with clients and working with, in the space in general is people say, well, how long does it really take to raise assets? As I said earlier, the due diligence process is expanded strategically, tactically, and that leads to temporal expansion. And I look at the world of raising assets in the alternative space in kind of two kind of environments. There's what I call BC, before the crisis and before Madoff. And if you look at the allocation pathway, which is the time it takes from initial meeting to ultimate allocation, and on the average, it was 6 to 9 months. And you contrast that against AD, which is after the death of everything. And in my opinion, the principal fatality was trust. The allocation pathway length has been extended considerably. It's gone from 6 to 9 months to 12 to 24 months or even longer in some instances. So that means and the reason for that protraction again is it's the due diligence process has been expanded. Strategically, people are looking at more things. Tactically, there are more people involved in the process looking at more things, and that leads to temporal expansion. That means the time it takes to get from the initial meeting to the ultimate allocation. And we all know time is money. So the longer it takes, the more expensive it is to raise assets. So here's a few data points around that allocation pathway issue. 200 meetings. That's the minimum number of meetings a new or smaller manager needs to gain traction in their segment. That's a lot of meetings. And you need to be prepared from day one and know where those meetings may come from, at least half of them. You should at least know where half of you, that 100, that half should be outside of your friends and family circle. 42 touch points from initial meeting to allocation. Over half of those touch points are in-phase meetings. In-phase meetings obviously are more expensive than if you're sitting behind a Zoom or WebEx, and I'll speak to that here shortly. The use of online tools like Zoom, WebEx, obviously increased through COVID, but at the end of the day, I don't know of one investor who's ever going to allocate to a brand new manager or relationship without some significant interpersonal contact and meetings. 2%, the percentage of institutional allocations to managers with less than 100 million AUM. So if you're going institutional, you think you're able to go institutional, consider you're looking for a very, very, very small segment and slice of the institutional community. Where do managers source capital? And this has always been something that I kind of counsel managers on. You see people going to conferences, at least before COVID, conferences and cap intro events were rather plentiful. Since COVID, obviously that type of activity has been reduced considerably. But even when those things were, proliferating, the personal network of the manager is the most powerful source to find the relationships to raise assets. And this information from AMA bears that out. If you're a new or smaller manager and you're less than 100 million AUM, going to conferences and paying those fees are not really in your best interest. You can have a better investment in your marketing if you understand your geographic and relational footprint. And I'm going to speak to that here very shortly. But this should guide your tactical marketing What are you doing for as far as tactical engagement? And again, making sure that you can understand and mine your personal network is going to be key to, again, the economical, efficient, and expedient raising of capital. What are issues that would prevent an investment in a manager? Again, most managers think the only thing that would prevent an investment in themselves is poor performance, and that's categorically not true. We are all in the business of evaluating risk. We want to be compensated for the risk that we take. Unfortunately, operational risk is a risk we don't get compensated for as an investor. So, and we also know, if we've been in the business any length of time, that operational risk is probably one of the primary risk that or it can lead to underperformance in a minimum level of in a minimum interest, but it can also lead in a catastrophic way uh, to catastrophic outcomes, poor operational risk management. So concerns about risk management are at the top of the list. Minimum investment ticket size. If you're a small fund, um, generally institutional investors need to write a large ticket, anywhere from 25 to 50 million, and they cannot uh, typically be more than 10% of your fund. So if they're going to make a minimum size ticket of 25 million, that means the fund has to be at least 250 million, not to breach their own internal concentration limits. So if you're a small manager and you got maybe 10, 15, 20 million, the max ticket that somebody might feel comfortable writing to you is around, if you got 20 million, it's going to be 2 million, 10%. But they will probably write a ticket far smaller than that in the getting to know you phase. Um, Businesses, a sub-institutional manager is a small business. And like every small business, there's a high failure rate of small businesses. So making sure that you have the wherewithal, the money in the bank to go through the process of growing your business is important. I'll jump over to some of the other things that I think in my almost 30 years experience have come up in as qualitative issues in the investment decision. Reputational risk, particularly within private wealth segments, single family offices, reputational risk is very is looked at very keenly. I already mentioned operational risk, career risk if you're dealing with an allocator, and headline risk. These are qualitative risk that are very much a factor in the allocation decision. So again, if you're a small manager and you think that the sole metric is investment performance, think again. There are a myriad of risks that investors and allocators and intermediaries go through and consider as they consider allocating to a new or smaller manager. And your marketing process should be make you aware of these, and you should be able to address them clearly and concisely when you're talking to an intermediary, an allocator, or an end user investor. I mentioned earlier about the due diligence process and how it expanded strategically, tactically, and that led to temporal expansion. And most institutional investors, they have a very high bar for the operational execution blueprint, and they want you to be optimally resourced. The challenge for a sub-institutional manager is to produce evidence that they are appropriately resourced for where they are, with a clear path to becoming optimally resourced as they go through the maturation process. So part of being appropriately resourced at every step of your maturation process, if you're a smaller manager, is having service partners as opposed to service providers. And I make a clear distinction around those two groups. Service partners are typically firms that have a vested interest or take a vested interest in rolling up their sleeves and helping you grow your business. They're helping you look forward into your business. They will not be the cheapest people. So if you're looking for the cheapest provider, then look again. You will probably look over to the service provider category where they function more in a commodity type function. They're going to quote you a price for a service. They will execute that service at a certain level. I'm not saying that it will be a suboptimal level, but it won't be the value added level that a service partner will bring. And there are some firms that are in the space operationally that help across the execution blueprint that are distinctly service partners, and you should ferret those out. We keep a short list of those firms. One of the questions that I get from managers, big or small, is, "Hey, maybe looking to change some aspects of my execution blueprint operationally? Can you recommend a new law firm? Can you recommend a new accounting firm? Can you recommend somebody who's in technology, a fund administrator? All those things. These are things that we help managers with here. So your execution blueprint should demonstrate stability, consistency, and continuity on an enterprise-wide basis. That's one of the, again, this is the operational execution blueprint is one of the easiest areas for an investor or intermediary to say no to a sub-institutional manager. So keep that in mind as you're out there marketing. Also, you can outsource the responsibility, but you can never outsource the accountability. At the end of the day, it all ends with the manager. You made the decision to hire whatever vendor you hired, and if they go sideways, it always comes back to you. So you should be able to defend and support every decision you make as far as what your execution blueprint looks like internally as well as externally. So again, going with the cheapest, provider is not necessarily what I would advocate, but also that old saying, you get what you pay for. If you pay a little extra for a service partner, you're going to get a little extra. So keep that in mind as you build out your firms going forward. There's no free lunch. Marketing requires continual investment. Too often, far too often, managers look at marketing as a cost. It is investment in yourselves, in your fund, and in your business. So do not look at it as a cost. So the average percentage of management fee dedicated to marketing, according to AIMA, is about 11%. Citi's prime broker came out with a study not long ago that the annual marketing budget, inclusive of compensation to their internal marketer, is about a little less than $280,000, and the approximate cost of an in-person investor meeting, a little over $300. So if you're going to have 200 meetings, just multiply 200 times 300, and you come up with about 60,000. So you're looking at a considerable amount that you have to really be prepared to invest in. And there are ways to mitigate that cost, particularly if you understand your geographic and relational footprint. And I'll talk about that, here shortly. So the acquisition cost of per allocation in private wealth is generally around 40 bips per million, 40 basis points per million, about 4,000. Institutional asset acquisition costs about 7,000. And that's simply because there are more layers in the decision-making process in the institutional world. You may have consultants, you may have investment committees, you may have board of trustees, there's a lot of layers that you may have to go through in order to get that allocation. So obviously, again, that takes more time. And again, time is money. Getting to the kind of the nitty-gritty qualitative issues. Here's a statement from Henry Kravis, and obviously we all know who KKR is. You only have one thing to sell in your life, and that's yourself. People are investing in you. Whether you have a separately managed account structure or a commingled fund, those structures simply are access points for your skill set. And those structures are places where you demonstrate or express your skill. So at the end of the day, whether it's a commingled fund or a separately managed account, it's access to your skill. And that means access to you. So it's all about you. You're selling yourself. You're not selling a fund. Any consistency in the return stream is a result of your skill on an enterprise-wide basis, you and your team, your business. So ultimately, at the end of the day, that's where the decision-making occurs. It comes down to you. People buy from people that they trust. There was this article that appeared in Institutional Investor a while back, really kind of sums this up. And the quote that's taken from that article here, I think, is a clear kind of synopsis of what I'm talking about. Even the best performing asset managers struggle to win investors' capital if they don't first win their trust. Again, as I said at the top of this presentation, of this briefing, this is a business about people, relationships, and trust. It may appear transactional on the surface, but it is driven by people, relationships, and trust. And again, also, as I said at the top, we want to make sure that we're doing everything from a data-driven perspective. So Chestnut Advisory, a firm out of Connecticut that publishes a great deal of high-quality, high-integrity research, came up with this chart a while back. Top 5 factors in driving the decision to allocate to a manager, basically hire a manager. They all culminate in investor trust. I, I, I personally look at investor trust and I say it's actionable conviction. That I have the actionable conviction about you, what you're doing as a manager, the business that you're running, and that way I feel comfortable and I have the conviction to allocate to you. But again, there's nothing in these 5 points about performance. Investor trust is the main driver. Investor trust is the main driver in most of our lives, if we really kind of step back and think about it. Trust, trust. Every allocation is an act of trust, first in you as a manager, the people you work with internally and externally. Again, let's go back to your execution blueprint. If you've got the right service partners, they can strengthen your overall manager fund profile, make you look a lot stronger than you perhaps maybe are. So I can trust the people you work with internally, trust the people you work with externally. I can trust the processes that you have in place internally and externally, and that they're going to be executed consistently at a high level. And if I can get some conviction around those things, then I certainly can get conviction around your performance. But if I can't get trust and conviction around you, the people you work with, I can't get trust and conviction around the processes that you execute, then I certainly can't get conviction around your performance. So therefore, I would not allocate. So understand that every allocation is an act of trust. And your marketing process should be trying to achieve the highest level of trust so it can then produce that actual conviction, which is the catalyst for any allocations to be made. Building trust is a process. Stephen Covey, I'm sure most of you have heard of him. If you haven't heard of him, you may have heard of the book that he wrote, The 7 Habits of Highly Effective People, one of the best-selling, most influential business management books of all time. And I think what Covey says here is spot on accurate. Trust is the glue of life. It's the most effective and essential ingredient of communication. And it's the foundational principle that holds all relationships together. Again, if I don't trust you, I don't care what numbers you're putting up. I'm not going to give you any money. And again, I still cannot say this often or frequently enough. This is a business about people, relationships, and trust. Do not get caught up in the noise and the hype that it's about transactions. How do you demonstrate trust? Again, trust starts with you. Are you reliable? Do you have a commitment to the business? Are you a high integrity person? Do you have sincerity? Are you consistently executing at a high level? Are you highly competent, highly skilled in what you do? All that emanates from the manager. So any trust that's built starts with you as the manager. So if you can't build that level of trust, again, you're going to have a tough time raising assets for your fund. If you're struggling to raise assets, you probably have a pipeline that does not have enough high conviction relationships of trust in your pipeline. Intelligence quotient. Most managers, because they believe that the investment decision is all run by their performance, they have a high degree of product knowledge and they constantly are pitching performance. So I'm very fond of telling managers, things you see here on the screen. Money is made from your IQ. That's how you do your job. Your competence level, your skill level, your analytical ability, your ability to execute in what you do. That's generally made in front of screens. However, on the opposite side, 180 degrees from that, is prospect knowledge. That's EQ, your emotional quotient. That's how money is raised. Money is not raised in front of screens. Money is raised in front of people. And how you building a relationship is not done in front of a screen. It's not done in front of a screen from trading. It's not done in front of a screen of a Zoom call. It's built face to face. So your prospect knowledge is how you close. It's how you get money in the door. Knowing more about your prospect is critical. So you've got to know as much about your prospect knowledge, as you do about your product. So IQ, how you do your job, the numbers you put up, that gets attention. But EQ, how you build relationships of trust and actionable conviction, that gets the assets. And if you're a small manager, you're wearing a lot of hats, you've got to be able to do both of these things exceedingly well, which is why I tell managers all the time that their marketing alpha has to be on near the same level as their investment alpha. Their skill level marketing, their ability to build relationships of actionable conviction and trust has to be almost on par with their ability to generate investment performance. 16 essential engagement traits. Um, you know, I don't know how many of you seen this movie, Glengarry Glen Ross. If you're a salesperson, you've probably seen it. I've seen it countless times. And Alec Baldwin's character in there is always be closing, is what he says. The reality is, when you're engaging with somebody, you are always closing. They are taking in everything that you're doing. So how you're engaging with them is either getting you closer to the close or pushing you further away from a close. And I've identified over 30 years what I think are the 16 primary essential traits of engagement. The top five are what I call mission critical. And you should be demonstrating these top five in every touch point you have with a particular prospect. Come across as a high character person, highly competent, you're highly credible, you have a compelling opportunity, and you're very candid about who you are and what you can do. Those are the five top mission critical engagement traits. So, because when you're speaking to engaging with a potential, whether it's an intermediary, whether it's an end user, an allocator, again, your prospect knowledge is going to be key. You don't want to be manager focused and investment focused. You want to be investor centric and prospect specific as you engage. What's important to that particular person you're talking to beyond your performance? So you've got to have sharp communication skills, sharp presentation skills, sharp interpersonal skills. As a rule, most of you have heard, or some of you may have heard of the 2-2-1 rule. You've got two eyes, you've got two ears, you've got one mouth. When you're with a prospect, you should be listening and observing twice as much as you're speaking. So just as a general guide. It's all about relationships. You don't close a sale until you build trust and a relationship. And trust and relationships are built through the marketing process. They are not built in sale. Again, this business is all about people, relationships, and trust. And if you're not raising assets, you don't have enough of those relationships. If you're struggling to raise assets, you're probably trying to sell or close a sale before you've built a relationship. Intermediation. The alternative investment business has a high degree of intermediation, particularly in the institutional segment. 96% of institutional assets are intermediated with a consultant. And how you market and engage with a consultant is different than how you market and engage with an end user. You do not, even the materials that you may have to provide are going to be different to that intermediation point than it would be to the end user. So again, if you have a one size fits all marketing approach, and again, if you're pitching, which is one size generally fits all, you're not going to be successful in raising assets if you're a new first time small manager. Again, everybody is idiosyncratic. We have different biases that we come to, we have different things that we look at. And consultants are very much in that way. So what do they look for? What do they look at as they work with the clients that they work with? Now, there's formal consulting, and we've got some of the big firms that are out there that we all know the names of. And there's informal, particularly in private wealth, you may have more informal intermediation than you have formal intermediation. And that may be in the form of an attorney, an accountant, a trusted advisor of some sort of friend of that family or that individual who is brought in to wants to take a look at you and they want to get another opinion. So if you're doing your marketing right and looking at that and you have that deep prospect knowledge, you should be aware of who these people may well be and be prepared to engage with them in a prospect specific way. That's all part of the marketing process. So here's a slide from an actual presentation from a top 5 consulting firm. The name has been redacted for obvious purposes, but when they look at the hedge fund world, they start out with an absolute return universe of around 7,000 funds and ultimately whittled that down to about 132 funds. Having seen this list from this particular consultant, they're all multi-billion-dollar funds. There's not one sub-institutional manager within that was within that 132 funds. So this is what they look at. This is their process. Whenever you are engaging with a potential prospect, your first job as a manager is to understand what their process is like in evaluating managers. What are they looking for? Who are they looking for? So that's part of the marketing process and understanding that in a very deep and acute way. Did a survey to about 300 consultants and asked them just basic question. What are some common mistakes that managers make and what should managers do? I'm not going to spend much time on this slide, but suffice it to say, the first thing under what should managers do to get your attention, spend time to build better relationships. Put yourself in the position of an intermediary, like a consultant or an advisor. How many pitches do they hear? How many do they want? And I can tell you personally, having sat on that side of the table and represented families before, I didn't want to hear a pitch. What I really wanted was a careful, considerable conversation that from a standpoint of understanding what I was looking for and what the families that I was representing, what they were looking for, and what we needed to have qualitatively and quantitatively as a solution. So pitching never works. It never works. Um, some post-COVID surveying looked out and found some information as to, again, tactically, what does the environment look like, the capital raising environment, marketing and capital raising, and these two quotes say the same thing. As I said earlier, Zoom, WebExes, all those things are great, but nothing replaces in-person, face-to-face contact. Again, people want to connect with people. And the best way to do that is face to face in person. I've yet to see in 30 plus years somebody just allocate brand new relationship a substantial amount of money through never having met somebody, never having sat down with them multiple times. So be prepared to have that in person engagement. And remember those five traits that I talked about before: being credible, being compelling, being candid, demonstrating that you are a high integrity, high competency person. All those things are being evaluated when you're in person in an in-person meeting, in-person engagement. The manager progression from 0 to 100 million, and 100 million is what is commonly referred to as the credibility threshold, particularly for a hedge fund. If you get over 100 million, and remember, 89% of hedge funds never reach 100 million. So if you get there, you're in some rarefied air, and people will look at you differently. But it all starts out with 0 to 50 million. That's what I refer to as conviction capital. Your investor-based opportunity set is generally your friends, family, some social, professional relationships. If you're lucky to get beyond that, to get to the next level, 50 to 100 million, you're an emerging sub-institutional manager. Your investor-based opportunity set has expanded somewhat. Maybe include some fund of funds, registered investment advisors, some family offices, single family offices, even maybe perhaps some multifamily offices. Perhaps operationally you're at the break-even point, so you're looking for critical mass capital. The next level up is, again, the credibility threshold, credibility capital. Your investor-based opportunity set is optimized. You're over 100 million. Minimum ticket size you can take is about 10 million. That's great. So that puts you, whether it's fund of funds, RIAs, family offices, endowments and foundations and pensions, the institutional universe is now kind of solidly open to you. So this is the manager progression. So understand the criteria of investors at each particular level of capital. What are the conviction capital people? Who are they? What are they looking for? What are critical mass capital? Who are they? What are they looking for? Credibility capital. Who are they? What are they looking for? Do make sure that you're marketing to the people that you're ideally suited for, given your manager and fund profile. If you've got $10 million, do not spend your time trying to market to institutions. It's a waste of your time and a waste of their time. And it's a waste of your money. So make sure that your pipeline is filled with those particular prospects that match up with where you are on the manager fund profile basis. Seeding, incubation, and acceleration capital is a question that I get asked about frequently, and these three things are opportunistic. When the business is going well, you'll get more people who have an entrepreneurial bug, may want to go off on their own, and they seek a seeding relationship, some incubation or acceleration capital. And these are some data points around that. Again, look at number two, word of mouth. That goes back to what's your relationship network look like? Are you going viral in your relationship network? So word of mouth is the biggest source of talent. Strategy and pedigree are ranked as the most important characteristics. And even if you do get some seed money, incubation, acceleration capital, the asset raising still is on your shoulders, and it's still the largest and biggest challenge you will have. The seeder, the incubator, whoever provides that acceleration capital, it's not their job to go out and help you raise assets. That's your primary responsibility as the manager. Again, know your profile, know your segment. If you know your profile, who you are, then you should know your segment, then you should know who your investors are. And the world, in my mind, breaks down into two distinct groups. It's the individual market, and an individual is an individual or family that has an asset size on par with a small institution. And that's versus the institutional market, which is your pensions, endowments, foundations, and the like. Now, the individual market is highly dynamic. If you look at through COVID, the amount of wealth that was generated by those individuals and families that were wealthy grew almost exponentially through COVID, and that group is increasing at a compounded annual rate of 16%. In the United States alone, there are over 50,000 individuals and families with asset size greater than 30 million. Now they are highly idiosyncratic. The snowflake phenomenon. If you've met one family office, all you've done is meet one family office. They are not alike. As opposed to the institutional segment, they tend to be more homogeneous. If you met one pension, the next pension is going to be public pension is going to be like that. And they're all facing the same problems, whether it's a pension, whether it's endowment, a foundation, and what have you. So, and that's a static universe. They're not really creating any more multi-billion-dollar pensions and endowments and foundations and the like. But you can see the number is quite large. Those institutional investors with assets over 150 million, a little over 24,000 of those. So it's a target-rich environment if you can get to the institutional level. Data point here that's certainly important for a sub-institutional manager to understand: the average AUM requirement of an institutional hedge fund investor is about 320 million. So do not chase mythical unicorns, what I call mythical investors who are going to invest in that newer small manager when you have little, very, very small asset base. Don't spend your time chasing unicorns. Who are your competitors? The competitive landscape is increasing every day. Everybody's chasing the same, and particularly in private wealth. You've got large alternative asset managers who are now moving away from the institutional segment and down into ultra high net worth segments. And they're chasing the same dollar that you're chasing as a small manager. And I can tell you from firsthand experience that they are polished, they're professional, and they're prepared, and they're ready to do battle because they understand how hyper competitive capital raising is. And if you as a small manager do not fundamentally understand who your competition is, how prepared they are to go after the dollar, you will lose. So it's incredibly important that you be adequately prepared in order to compete. So in my mind, competition comes in three kind of flavors. There's the qualitative competition, and what I mean by qualitative competition is, there are already people who have established relationships of trust and actual conviction with the investors that you're going after. So, I have a saying: happy money never moves. And typically, those established relationships of trust and actionable conviction are that's money that's happy. It's not going anywhere. Now, quantitative competition: who in your space is outperforming you? Again, quantitative means what? Who's putting up better numbers than you're putting up?
And then structural competition. We've got a large and growing segment of replication strategies that are passive now. That means lower fees, and we all know that the fee discussion is top of mind with most investors in the alternative world. So if they can get something that's similar to you and a lower fee and a more liquid structure, that is your competition as well. So you've got to be, again, very prepared to have discussions around these topics and be prepared to compete against whether it's qualitative competition, quantitative competition, or structural competition. This is a wealth dispersion analysis that we do semi-annually here. We want to find out where all the private wealth individuals are state by state, because this helps us help clients with tactical outreach and tactical relationship building. So most managers do a poor job, most sub-institutional managers, that is, do a poor job in understanding their geographic and relational opportunity set. And generally speaking, that's anywhere you can kind of go in the morning, you drive in the morning, come back and sleep in your own bed at night. And so, for example, my firm is here in Austin, Texas. There are over 5,200 individuals and families in Texas that have a minimum net worth of over 30 million. So Austin, Central Texas, I'm a 2 hour drive from Dallas. I'm a 2 hour drive from Houston. I'm an hour and 10 minute drive from San Antonio. So there, as opposed to, why would I get on a plane if I'm a manager in Texas and then go to Chicago or New York or Los Angeles, or even worse yet, I've been in Europe and seen managers from the States, and I say, emerging managers. So why are you here? It is a fundamental lack of understanding of the relational and geographic opportunity set. Now, a part of that is what I call the intermediation overlay, particularly in private wealth. Every family or individual in private wealth has an attorney, an accountant, or somebody that they do business with that is instrumental in helping them, preserve, protect, expand their wealth. And they are sometimes part, again, as you go back to the intermediation slide that you talked about just previously, they are part of the decision making process. So generally speaking, what that intermediation overlay does to this wealth dispersion analysis, it bumps that number up by a factor of 3. So here in Texas, if we're using that example, there are over 5,200 individuals and families, minimum net worth of 30 million. Do you multiply that by a factor of 3 when you add in the accountants, the attorneys, the other professionals that are service partners to those families, you're getting to 15,000 contact opportunities to build relationships. And that can keep any manager, big or small, in their marketing busy for a long time. The other part of that is understanding your geographic and relational opportunity set. It drives down the cost of your marketing. If I drive to Dallas, what is that? That's not even a tank of gas back and forth. However, if I get in a plane and I go to Chicago and I go to New York, I got to book a flight. I got to stay in a hotel. I probably take some people to dinner. You're talking about easily dropping, maybe close to $1,000, $1,500. It's not too many of those trips I can make if I'm a small manager, as opposed to maybe, depending upon what gas prices are, 30, $50 in gas. I can still, go to Dallas, take somebody to a nice dinner or a nice lunch, get to know them, they get to know me. Maybe I've dropped maybe $300 as opposed to 1,500 going outside of my geographic and relational footprint on an opportunity set. So keep that in mind as you're building your pipeline and doing your marketing. Mistakes happen. We all understand that. And I'm going to go over some of the most common mistakes that sub-institutional managers make. The field of dreams mentality. If you build it, they will come. If I put up performance, the world will come. And that is categorically untrue. If you put up numbers and you're an emerging manager or a small manager, not only won't they come, they won't know and they won't care. Again, you've got to understand how decisions are made, how talent is identified. So don't think that all I got to do is put up numbers and the world's going to be the path to my door if you are a small sub-institutional alternative manager. That generally was not going to happen. If you build it, they won't come, they won't know, and they won't care. 4 big mistakes that most sub-institutional managers make is that performance-focused marketing, pitching performance. They will put what I call post and hope, post their performance on databases or platforms, hope they get some visibility that, by a large number, and people can say, hey, how's that person putting up those numbers? Let me engage with them. That doesn't happen. Spray and pray, which is, probably it's at an epidemic level now, where people will spray out emails, put their performance in the subject line, and hope somebody gets somebody's attention and they respond. That's not marketing, and not only is it not marketing, it's just the wrong thing to do. I've spoken about pitching performance. I've also spoken about chasing unicorns. These four things, just to be clear, that's not marketing. That's not intelligent marketing in a climate filled with sophisticated, highly skeptical, idiosyncratically demanding, stringently selective investors, intermediaries, and allocators. This is not marketing in that environment. Trust and relationships are not built by pitching. Pitching is, again, it's manager performance focused. It is not investor centric or prospect specific. One of the things that I tell managers as I work with them, prescription before diagnosis is malpractice. That's what pitching is. Think of it as if you went to your physician and you've got a major illness, and before that physician checks your blood pressure, looks in your eyes, takes blood work, all they do, and before you tell that physician, hey, this is what's hurting me, or this is what I think the problem is, this is the symptoms, they just hand you a script and say, this is going to fix you up. That's what pitching is. Before you deeply understand qualitatively and quantitatively that investor, do not offer a prescription or a solution. Your job should be, again, prospect knowledge. And to go back to that slide, your EQ should take over. It's not your IQ that's going to get the assets. The IQ gets the attention. It's the EQ that will bring the assets. So stop pitching. To that end, what you should be doing is presenting. And you can only present when you have a process. And remember, if we go back to the beginning of this briefing, 81% of managers with less than 100 million do not have a formal marketing process. 27% don't even invest in the marketing process. Don't invest in marketing at all. So again, you need to be a resource and a solution, not a pitch. And presenting, think of it as when you go to that favorite restaurant you go to, or your country club, or where you play golf. And everything is done from a standpoint of a thoughtful, careful presentation, a respectful presentation to you. That white glove treatment, that's presenting. Pitching is throwing things at people. I don't want to have anything thrown at me. I don't think you want to have anything thrown at you either. So get a process and start presenting if you are a smaller manager. That's incumbent upon you if you want to be successful raising assets. So the key takeaways here, and I hope you bear with me through this presentation, this briefing. I've often tell managers that, this whole thing is like an Ironman competition. The swim, the bike, and the run, that's marketing, fundraising, and investor relations. It's a triathlon. It's not a sprint and it's not a marathon, it's a triathlon. And you have to have a process, you have to have patience, persistence, you got to have great skills, and you have to consistently execute if you want to win in this Ironman marketing, fundraising, investor relations competition. All those things are just mission critical. Marketing, fundraising, again, sobering statistics, but sobering data points, but need to be understood. It's DIY, it's do it yourself. 4% of managers with less than 100 million AUM secured an allocation via the Cap Intro team. 0% got an allocation via a third-party marketer. You are on your own if you are a sub-institutional small manager. The marketing, capital raising functions, fundraising, it's all on you. And you've got to have a process, and you need to know what to do step by step, day by day, so you're not wasting time, you're not wasting energy, you're not wasting effort. No marketing process, again, inconsistent, inappropriate, improvisational behavior in action. That generally leads to suboptimal outcomes, failure raising assets. So if you're frustrated, you're upset, look at your marketing process. If you don't have one, that's the reason. So no reason to get upset. Now is the reason. Now's the time to get to work. Get a process installed. Don't be upset by the results you didn't get from the process you didn't install and the execution that you didn't bring to the process. So that's it here. If you would like a copy of this, hard copy of this presentation, happy to provide it to you. Again, just email me directly and just say, hey, Bri, I want a copy of the presentation. Simple as that. I hope that this has been helpful, insightful, informational, and instructional. There's to all the managers out there. I also want to emphasize this is a synopsis. There are a myriad of other issues that go, qualitative and quantitative issues that go into the marketing process for a sub-institutional alternative asset manager to be consistently successful raising assets. So this is designed just to be a brief synopsis overview, a briefing. Again, this is a briefing. It is not a deep dive is very exhaustive, and we go through that with managers in order to make sure that, again, that they are prepared, they're ready, they're polished to go out there and compete at the high level required in order to raise assets, because it's a hyper competitive environment trying to fight for every dollar from against people who are, again, they're prepared, they're polished, they're ready to do battle. Are you? So as I say to everyone all the time, continued success. And again, if you'd like a copy of this particular presentation, please just drop me an email and I'm happy to provide it to you.